Alright everyone, Cowboy Trades here, welcome back to the channel for another update on the SP 500. In this episode I wanted to update a few different charts, but I mainly wanted to focus on what is currently happening with this gamma squeeze in the options market, which has allowed the SP 500 to rally back up to this macro trend line. We're going to be talking about this macro chart, of course, updating our Elliott wave theory pattern, which is still playing out. We talked about this the other day. I'm also going to be talking about this divergence between the VIX and the VVIX and how this will affect the price in the immediate short term. We're then going to wrap up talking about earnings season and also the S&P 500 price to earnings ratio. So quite a few mini things that I did want to dive into today. Now, like I said, the main focus on this video is this gamma squeeze that is currently going on. So if we do head over and look at some of the options expirations, I'm going to be focusing on what happened last Friday. Before I do that, let's come over and look at what actually happened for the S&P 500 coming into Friday. If we come over to the mini futures for the S&P 500, get out of the Fibonacci candlesticks, head over to the 5-minute time frame, you can really see, basically what happened right at the end of the trading day is, we came up to round about this 4,100 strike level, which I'm going to talk about in just 1 second. And as soon as we reached this 4,100 strike level, we basically just started falling from there. And then the futures started to open yesterday on the 29th, and now the stock market is opening. It looks like we are getting ready to push back down to the downside. So why has this happened? Why did we push up to 4,100? Why is this level important? And why at the end of the trading day did we hit 4,100 and start breaking down to the downside? Well, this really links into the options expiration. So we're going to be looking at, once again, the 27th, what happened on Friday. We're going to sort these options expirations by volume and also put a volume graph over on the chart to see, where the majority of these options expirations came into place with the strike. So as you can see, sorting by volume, you can see huge strikes at 4,100, 4,090, 4,080, 4,095, 4,075, 4,085. You can see a few more, but in general, the lower you go down in terms of volume, you're not really looking at levels around about the 4,100 level. So we really got magnetized to this strike level around about 4,100. And when we are looking at this volume graph that's overlaid here, you can see the majority of this volume, the majority of the expirations that happen. If we look at the IV over here, over 6%, literally almost all of the expirations happened around about this 4,100 level. So we basically, coming into Friday, had a gamma squeeze up to 4,100. If you haven't heard of a gamma squeeze before, it's very similar to a short squeeze, except this happens in the options market, and this is caused by market makers coming back into their positions or exiting their positions. So basically, if you were a market maker and you were trading the options market, and if we do come over to something like the weekly time frame, if you're expecting price to start coming to the downside and you start hedging yourself into some bearish options around about here, and the price starts to move back up to the upside, for example, rallying into earnings season, rallying into the FOMC like we normally do, and this counteracts how you're currently trading, then you might have to start buying back the underlying asset for your options. So once again, this is very similar to a short squeeze. It's like when short traders are in short positions, they get liquidated and they have to buy back the underlying asset, which continues the pump. A gamma squeeze is very, very similar, but this happens in the options market, bleeds into the equity markets for the S&P 500, and this is kind of why we saw a little bit of continuation coming into the end of last week. And once again, coming over to Friday's expirations, the majority of these strikes, if we look at the IV, the majority of the volume was all up at this 4,100 strike level. Not many puts, but many calls for round about this level. So what does this mean for the price now? Well, when we do come over to the S&P 500 and look at this Elliott wave chart that we talked about 5 days ago over on the channel, you can see this beautiful structure is still in play where you've got a 1, 2, 3, 4, 5 wave bearish correction, and we've come into a 5 wave ABCDE asymmetrical triangle, which is a bearish continuation pattern after a 5 wave to the downside in a bear market. So you can still see this consolidation is in play. If we do come over to the 4-hour time frame though, you can see beautiful touch points at A, B, C, D, and when we came up to E, I will talk about if this is still valid in a second, but you can see that we did temporarily manage to break above this trend line, and of course this was because of the strike prices up at around about 4,100. Now, technically the Elliott wave pattern is still 100% in play, especially when you take into consideration the options expirations, especially when you take into consideration the earnings season rally, and then also when we're talking about the FOMC just being 2 days away. If we get that 50 basis point increase, then if we start snapping back down to the downside of this triangle pattern, this is still going to be beautifully in play. And in terms of the Elliott waves, you can see your A wave is all the way up here. Your C wave, will not be invalidated until around about 4,132, and this is still, lower lows and lower highs all over the board. Well, lower highs rather, because as you can see, D in terms of this asymmetrical triangle should be higher than B, otherwise it won't be an asymmetrical triangle, but nonetheless this bearish continuation pattern is still in play. As of the time of recording, the markets have just opened, the equity markets have just opened, should I specify, and we're currently rallying right back up to this area here, which was resistance. We broke above it, came back down for a back test, broke beneath it, and now we're retesting this as resistance once again. So 4,055 is a huge area to keep your eyes on. Now, like I just mentioned, for this Elliott wave pattern to continue playing out, we must not break above 4,133. So if we do come back over to the options expirations, you can really see, 4,100, and in terms of the volume that's tapering down, you can see you come down to round about this 32,000 level, and then you have a huge drop off in volume. So there really isn't many strike calls above 4,110. The strike calls that are beneath this level have, subsequently much lower volume and are much less likely to get hit. So once again, I'll keep you up to date on this. It does look like we're retesting this bearishly at this moment in time, and of course, just like I talked about in the Elliott wave video, I do expect this to break down into the FOMC meeting once we have 50 basis points, which is my prediction, and I expect the markets to continue to plummet to the downside, especially after this macro Elliott wave theory, which has beautifully been playing out since the all-time high, is still absolutely in play. This asymmetrical triangle after a 5-wave rejection to the downside, 5-wave asymmetrical triangle, is very typical of a bear market consolidation in Elliott wave theory. So keep your eyes on these levels like I just mentioned. Now, one other interesting thing I did want to talk about is when we do come over to the VIX, the volatility index for the SP 500. We've of course talked about this many times on the channel. This trades inverse to the SP 500. What's interesting is this, spiked back up in the past couple of hours once it did open. But what I really want to highlight is if we do come over to the daily time frame, we are still holding this level strong. We did temporarily, very quickly wick beneath this low established on the 13th of January. In terms of candle body close, we closed above support, and now we are pushing back for the VIX. But of course, we're really not having too much of a big rally for the VIX at this moment in time, and this is where I wanted to come over to the VVIX and compare this to the VIX. Now, the VIX is the volatility index for the S&P 500, and the VVIX is the implied volatility for the VIX. And often, if we're looking at the daily time frame, I've color-coded this so you can, really see the difference between what these are. Let me change the border just so it's not ambiguous. So this red line graph here is the VVIX, measuring the implied volatility in the VIX, and the VIX up here in blue is the volatility index for the S&P 500. Now, we really want to focus on the red trend line right here, because a lot of the time, over here it topped out at the same time, over here it pretty much topped out at the same time, but a lot of the time, you see, for example, over here, the VVIX started rallying, and because of this, the VIX started rallying afterwards, because this measures implied volatility in the VIX, so it moves a lot of the time before the VIX. You can also see when we flatten this data, this bottom over here on the 6th of January was choreographed, about a week later for the VIX. And since then, if we do come over to the VIX once again, measuring up this low, you can see on the 23rd of January, the VVIX started bouncing, and, only a couple of days ago, the VIX started to hold that support level, and now we're starting to bounce back up to the upside. So we're seeing this very slight divergence right now, where the VVIX is pushing up higher and faster than the VIX, and this could be a telltale sign that the VIX is getting ready to finally snap back up, while the VVIX makes a lead back up to the upside. Like I also said, earnings season this week, we've got some very notable names. I will leave the source to this down below. I don't think it's too important to go through and mention, every single day when there's earnings reports. If I do see anything, interesting or any, outlandish earnings reports, I will post them over on my Twitter at 618_cowboy. So be sure to come and follow me over here. The last chart that I did want to wrap up on is something called the SP 500 P over E ratio, which is basically the price of the S&P 500 divided by its earnings ratio. So this is especially important coming into earnings season. And what I really wanted to update is if we look at the last reading for the price over the earnings, this clocked in around about 19.17, which was a drop from 19.69 in the previous quarter, and it's down from 24.56 year over year. So basically this means we've had about a 2.65% drop in earnings from last quarter and almost a 22% drop year over year. Now, if you've got a Bloomberg terminal, this will have been updating with the most recent earnings season, which as a majority has been coming in slightly lower than the previous earnings season. So what's actually happening is if you're looking at a Bloomberg terminal, the price over earnings ratio has actually dropped around about 18. So there's basically been no earnings growth in this cycle. So we're basically almost done wrapping up earnings season. Like I said, there's going to be some notable earnings coming into this week, but I just wanted to get a few thoughts out to you. I don't normally cover options. I don't normally cover gamma squeeze, but looking at the amount of volume that came in on Friday's expirations at this 4,100 strike price was definitely a telltale sign that this was one of the reasons why we did get a little bit of continuation. And of course, Elliott wave theory is still playing out in the macro time frame. VIX is starting to push back a little bit on the lower time frames, and also the VIX is pushing up. Indicative implied volatility for the VIX is going up. VIX should soon snap back up with the VVIX. 2 days away to the next FOMC meeting. I think we're going to get 50 basis points. I think that will pull the markets back down. Liquidity is overextended. Cost of trade is super overextended. Price over earnings ratio is coming down, meaning that earnings season was not as bullish as a lot of people were hoping for. There's basically been no earnings growth. Like I said, just wanted to share these thoughts with you. It's all I've got for you for this video, my friends. As always, if you do enjoy the content, let me know down below by leaving a like and a comment. Share the videos with your friends. And if you do want more of my posts, charts, memes, economic data, all of that good stuff, be sure to follow me over on Twitter at 618_cowboy. Come and join the Discord. If you click on the About section, you can see I've got my Twitter, Discord, Instagram, and official merch store all linked down below. So for today, my friends, that's all I've got. It's been your boy Cowboy Trades. I'm out. Peace.